Eric Calderon, welcome to Acquiring Minds.
Thanks, Will. Nice to be here.
Eric, your path into buying businesses started with a traditional search fund. Today, you're buying and holding businesses in TXE Partners, in something of a Holdco independent sponsor hybrid. We're going to hear about all of this. First things first, some background on you, please, Eric.
Yep. So in terms of my background, I'm a native Houstonian. So my business is structured here as well. So it's kind of been a neat full circle to be able to come back into my community and build a business here. I know there's some specific points that folks will already know, but I think emphasizing that I'm an engineer and kind of had a whole career mindset, which was born around being an engineer, and then found the path to search as just kind of something that wasn't necessarily expected, but certainly had the entrepreneurial kind of instinct that was realized in business school, and being able to jump into getting my hands on a business through a traditional search, and then ultimately, fell in love with the business model and wanted to do it over again. And that's what's led to TXE Partners and the ability to have now a few different companies that we're focused on. Yet I didn't leave the engineering background. So a lot of our businesses are involved in manufacturing or in sciences, and it's been neat to kind of see the hybrid use of the technical skill with the kind of standard financial skills that you would expect in the search fund, and apply those into our operations and businesses.
Great. Well, we're going to hear about that. And just going to your discovery or your decision to pursue a search fund, bridge the gap between whatever you were doing before and why you pursued a search fund.
Sure. So, to be actually very, very honest here, I went to business school fully believing I would graduate to be an engineer, come back to be an engineering manager. So I was trying to add a business skill set to continue being an engineer and work my way up a corporate kind of ladder, if you will. And it was a little bit of happenstance that I ended up finding the search fund model at Harvard Business School. I ended up having an opening in my schedule, signed up for the class at the recommendation of a friend, and that kind of introduced me into a whole world I didn't know existed. And I think what really drew my interest is, if you don't know about this model, you can't really appreciate that there's a way to become a business owner and like a hands-on operator so quickly out of business school. And I think the appeal there has some similarities to what I had done in engineering, which was, kind of solving problems across like multiple parties and, complex, capital projects is what I was doing before. This in some ways had some mirroring of that. They kind of got your arms around something. And I think the other thing I really was intrigued about is the search itself. I can kind of look back on it now with some commentary, but just, on the front end of it, it had some mystery to it. Like there were some best practices on how people have approached search, but there's really no standard playbook. There is.
What year was this, Eric?
I graduated HBS in 2013.
Okay, so this was early days of
search. And I say there's no playbook. I mean, there's certainly best practices, but if you were to interview, a handful of different searchers that acquired something, they all have a different way that they got there. And so, I think going through that experience and kind of understanding that this was in many ways very entrepreneurial, that I had the freedom to decide that I wanted to go into a certain industry or a certain geography, I think was very appealing, because I was kind of writing my own path on what I could do. And of course, I decided I wanted to follow something in oil and gas as a searcher, because I had worked in that industry before. And so for me, it really felt like a way to see an industry I'd already started to know in a different light.
Yeah. Well, interesting that the entrepreneurial nature of it appealed to you. Not interesting. Anybody who pursues this path is going to like that about it. But it sounds like you were not at all destined to be an entrepreneur. In fact, you just said explicitly you envisioned yourself climbing the corporate ladder for your whole career. So kind of interesting that you had never seen yourself or aspired to be an entrepreneur before that, or am I wrong?
Definitely not with a lot of effort behind it, right? So I can admit among, friends here that I didn't even go to job interviews at HBS. I was kind of understanding there was a company I had worked for before. They were probably a good fit for me to go back to. So I was very much tunnel vision on what I was going to do in post-business school until I learned about the opportunity to do a search fund. And I think for me, that's, there's certain aspects of that are unique, but I think that's the benefit of being able to have, a business school experience, that you get to learn about things you didn't know existed.
Yeah, for sure. Well, and of course, a testament to Rick and Royce. you are referring to the class, the now famous class by Rick and Royce, the authors of the HBR Guide, and of course now podcasters. They have a podcast interviewing searchers as well. And that, though, they've been on this podcast and they talk about the class and how much it's grown over these last 10 odd years. That must have been one of the very earliest years that the class was offered. How many people were in it? Do you recall?
Yeah, so they have two classes. There's kind of one that's more of a traditional course on just small business. And I think that one, had 150 students or so. But my year, they had launched kind of a part 2 for folks that really want to dive into this after graduating. And that class was more like 30 or 40 people, so a much smaller number of us that could work. And you're exactly right. Well, that class, that set of experiences that I got with those professors and with those classmates really helped me go from this being a concept to actually something I might be able to do. Actually talking about how do you structure a transaction? How do you, close the deal? What does day one of operations look like? And, getting to read those stories, I think really kind of helps you understand, like, is this for me? Is this something I want to do? And, of course, when you get two great mentors like, Rick and Royce as people that you can continue to interact with and learn with, I think it became, for me, something that I felt like there was a network between my classmates that were going to search, between these professors that were kind of building this community that I could work through and learn together with and ultimately find a business to acquire.
Yeah. And in fact, Rick and Royce did become true mentors because they invested in your search. So now take us into the chapter of your actual search.
Yep. So I did a search that was, I would say, somewhat, limited in terms of both geographic constraint and a industry constraint. So first and foremost, wanted to acquire something in the oil and gas sector, as I noted earlier. Fortunately, that does align well with the Houston market. There's a big oil and gas sector here, but in many ways, I was kind of drawing the funnel a little bit tighter than I think best practices had been on how to search. And so for me, I was approaching the search not as a volume game of, trying to send as many emails as I could or trying to look at kind of deals across the country. I wanted to be much more constrained in trying to find something in this local geography and in this industry. And so for me, what that meant is that some of my sourcing was a little bit different. You, of course, did the standard things of working with brokers and trying to get on to, to listservs to make sure you could see deals. But I also did a lot of work around trying to get to work with local accounting firms that may have clients that were kind of reaching retirement age, working with attorneys that were here in Houston. So trying to do a lot more to build like a Houston-based network to find deals. I tell you, that's the approach I took, but it's actually funny how I found the deal that I ended up transacting on. So LK Industries is the first company that I bought. It's a niche manufacturing firm in Houston that makes oil testing equipment. The way I got connected to that deal is I was looking at another deal in Dallas, Texas that turned out not to be a fit. And in kind of downloading with the broker afterwards, after we had kind of gone to visit the company, he asked me the question, like, what is it that you're looking for? Try to just be helpful and try to give me the next deal. And I remember telling him, I wanted a business near Houston. And I specifically said, I like businesses with a long operating history. And at that time, that kind of thought for me was, if a business has been around for 40 or 50 years, they're doing something right. And so that particular conversation, that broker recalled that he had a colleague, another broker, who had this really old company near Houston. And he's like, let me introduce you. And so this broker that ended up having the LK transaction was based in Iowa. And the way that he ended up connecting with the owners of LK, this Houston business, was through cold mailing, literally writing letters to different business owners. That was his model. The hit rate on that has to be low, but he wrote this letter that the owner of LK Industries responded to, saying he would like to work with him in selling the business. So the connection happened there. And it took me about 15 months to find LK. So from kind of first day of searching to being under LOI took about 15 months. And LK turned out to be just kind of the right fit from all different measures. I summarized that 15 months pretty quickly, but there's a lot that happened in those 15 months of searching. And so we kind of seriously looked at about 165 deals in that time. I had indications of interest, IOIs, on 16, and then did 3 letters of intent, 3 LOIs, the third one being the LOI for LK. First 2 LOIs, fell apart for kind of different reasons. There's definitely some learnings there we can elaborate on. But those numbers of 160 deals, I think, to some that sounds like a big number, to others it sounds like a small number, but we were certainly trying to curate and look at ones that passed our first funnel, being in the right industry, and second, being in the right geography.
And your definition of looking at them would have been signing an NDA and looking at the full
NDA, getting the SIM, reviewing, in some cases having calls with the broker owners.
Great, Eric. Well, let me react to a few things there. First of all, when you were doing this search, Rick and Royce, while they had taught you and were maybe mentoring you and invested in you, they had not yet written the book and kind of codified the those criteria that we all now hear so much about the ideal business for a searcher. But oil and gas was certainly not it. Oil and gas, you don't see a lot of searchers in oil and gas because it's so cyclical, correct?
That's right. And I would say kind of the approach of what we were looking for changed from kind of day one to what we ultimately transacted on. And one of the biggest changes was moving away from anything that would be service related. We started to look more on like product based businesses and manufacturing because of the capital intensity in which like oil and gas service businesses can have. Obviously, we're trying to buy small. So one kind of pivot we made along the way was to look for a manufacturing business in the space. Still, to your point, the cyclical nature of oil and gas is certainly makes a deal with any sort of leverage hard. And so, we believed that we could do a little bit better than someone who maybe didn't know the industry only because we had been in it, being cognizant of what cycles were, and trying to make sure we bought not at an up cycle, trying to buy at a fair price that could get us through a down cycle. I won't say we did that perfectly, but I think we did it okay. We did experience kind of some cyclical challenges shortly after closing that we navigated, and I can unpack a little bit more. But I think within the oil and gas sector, we did our best to try to be in a place, and we landed in like the mid, what they call midstream or like a pipeline part of the business, and that has a little bit less cyclicality.
Well, the other thing to your earlier point about one of your criteria being the longevity, that would indirectly tell a story of a business that even if it's in a cyclical industry, it has survived those cycles. So you were trying to kind of triangulate a business that had survived the cyclicality. The other thing I'll say, you just said something there, Eric, that was interesting to me, that services businesses in oil and gas have CapEx, and so you shifted to manufacturing, implication being there's less CapEx. That is completely counter to how I understand the world, which is that services, of course, I guess it depends on what the service is. And services generally are lower CapEx. Manufacturing is high CapEx. So reconcile that for me.
Sure. So when we talk about like oil and gas services, that's kind of a sector that does everything kind of at the wellhead. And so there's just a lot of capital intensity to like equipment that has to be used out in the field on those services. Probably use that more as like an industry term than rather a broader to like a oil and gas specific services kind of term. For us, looking at like a manufacturing business, this is niche manufacturing. So small manufacturing of like a niche product, and being able to find a company that had, a really good amount of kind of equipment already on site, like the CNCs already purchased, we could kind of do a filter to make sure we didn't need new ones the day after closing. That a lot of the manufacturing was in subcomponents coming from, key vendors. And so being able to kind of look through and say, this is a business where its current operating level is sustainable, maybe even can grow some without significant CapEx in terms of being able to produce a product at a volume that generates the revenues we want. I can just elaborate a little bit more on where this went. So as we continued to kind of look at this business, we did a bolt-on acquisition shortly after acquiring LK. And that was one of our key vendors that did calibration of our equipment. So imagine a manufacturing business makes a piece of equipment, sends it out to a third party for a calibration. We bought that calibration business and insourced it. And I think for us, Will, that turned out to be like a really interesting kind of pivot in what we were doing, because we then were able to bring in a service to the manufacturing business that really redefined the company to be more in the testing, inspection, and calibration sector, as opposed to a true manufacturing business. And that turned out to be a really good win for us as we ultimately exited the company.
Great. Well, we'll turn our attention to that. There's a lot of interest these days in there's kind of a short form vernacular for testing and inspection businesses that
the TIC sector.
Yes, TIC.
Yeah.
Thank you. Yeah. So we'll get there. I just want to, before we leave your search, want to say, first of all, how this Iowa broker got LK Industries by sending cold letters.
Real letters, right? Yeah.
Actual letters, but also just for the audience, you're not only competing with other searchers when you're doing cold outreach to sellers, you're also competing with the brokers themselves who are basically making, a similar pitch. I'll help you find a buyer for your business.
If I can, I think one thing that I also learned from that is often I was tempted to only kind of filter who I was talking to or who I was interacting with by the belief of people in my region might know deals in the region. And yet I found this Houston-based company from a broker in Iowa. And so for me, kind of one of the things I learned from that is, as a searcher, you got to tell your story to anyone who's listening. You never know where that deal will come from.
Yeah. And that was the final point I wanted to make, which is that you just kind of did all the things, right? You were just basically, to use the cliche, creating a surface area of luck because you didn't know where the deal was going to come from. So fair to say, you just kind of did everything, talked to everybody, talked to accountants, told your story to everybody, hoping that at some point there would be some contact with some lead on a deal that you buy. Is that a fair characterization?
It's fair, and I also say I had a little bit of the advantage of the search fund being relatively new. So as I was having those conversations, a lot of times people had not heard that term, which meant I got the benefit of kind of bringing to them a new concept to explain this is what we're doing. And I think, now the model's become more mature, but at that time being, possibly the only searcher in Houston or one of very few that was active in the market in 2013, was a good way to be able to make an impression on folks.
Yeah. No, that's a great point and great advantage because every owner now is getting 5 emails from search funds a day, so there's no intrigue there at all. Great. And can you tell us about the numbers of the business and also the structure of how you did this? It was traditional search fund economics, so maybe that part first. What was the structure of your search and with your investors, Rick and Royce or others?
Yeah. So Rick and Royce were our two equity providers solely. So it was kind of their funds that they put in, and we had kind of a standard 20% kind of PE model that was a sweat equity component, and so we had the chance to co-invest with Rick and Royce personal funds, and then we kind of had a 20% equity ownership that we would get after hitting certain hurdle of a return. So. For me, I mean, at the time, as you kind of noted, this was early days. So that seemed like a pretty standard model that I think was kind of modeled off of the normal PE kind of model, the 2 for 20 model. Sure. And so that felt like kind of right in the ballpark. So we put leverage on the business. And this is kind of an interesting concept of how we decided to leverage the business. So having the good fortune of working with Royce, there was a lot of different, financiers that he had known over time in his career. And so got to talk to a lot of different debt providers, both bank and non-bank lenders. And I had a thesis on wanting to work with a community bank to be able to do the debt. And for me, part of the thesis there was like, look, I'm talking to a lot of these banks to try to find a deal. It'd be nice that once I find one locally, like I can actually work with one of these banks, have that bank be a kind of a community partner to our business, work with my employees, work with us on the credit lines going forward. So, trying to do my best to keep the kind of banking relationship local. And so we ended up working with a community bank. At first, we were going to do an SBA loan. And then we decided not to do an SBA loan and had a community bank here in Houston, a very small bank, only had 3 locations here in Houston, a very small bank, decided to match the SBA terms and do the loan for us. And what was kind of interesting about that is when you have only a 3-location bank, I was talking directly to the CEO of the bank and, the vice president of the bank. And kind of in one of my, best moments of search, we had this deal pending approval. And the chairman and CEO of the bank calls me and says, I need to come see the business. Literally comes to LK Industries. I don't own it at this point. Bear in mind, right? We're still trying to get the deal closed. And I tell the owner, I was like, look, I've got some people coming. I want to see the business. And he just kind of says like, sure, go ahead. Here's the keys, if you will. And we did a full walkthrough of the business and sat down in this little kitchen, a small little table. I was basically grilled by the CEO and chairman of all these different questions and what ifs on the deal. And as he left, he got into his car. I got the approval. And so there was like a real, like, I've got to do this in-person diligence from his end, and they did the approval on the transaction. So that was kind of a neat story, and I think ultimately turned out to be really good for us, because as we went through the inevitable oil and gas cycle, which we did, we saw some highs and lows in that. It was really good to have that bank partner, because literally they had an understanding of the Houston market. They had a portfolio that had a lot of oil and gas deals. They understood kind of the ebbs and flows of the market, and worked with us to make sure that, we were able to get to the other side of any sort of blips that we were seeing during our operating cycles.
And so do you think that that's generalizable advice for folks listening, or do you think it's working with a community bank made particular sense in your case because you're in this cyclical industry, in this industry, you're in a kind of an industry town. Houston's an oil town.
There's definitely that aspect. I think so all the deals we've done since have continued to be with community banks. And I think for us, it's not just the industry cycles or the type of industry you're in. I think it has to do with having a business in the community where the bank is banking, right? And so that's turned out to be really important for us, that we have these close relationships with the bank. They can come and see our businesses. They do indeed actually do a lot of programs with our employees to help them get auto loans and personal financing loans. And so we've built really deep relationships with our bank. And that's a model we want to follow going forward. Fortunately, our businesses have done, reasonably well. But I think sitting across from a bank and having them understand the nuances of a business, if it is kind of going through dips, is really valuable, because we're not having to do anything other than, schedule a time to meet in person and kind of go through this. And so for us, we're really committed to working with those community banks, because they have an interest in the community doing well, which includes our business. And so I think it's a very symbiotic relationship.
Yeah, absolutely. There's kind of a double incentive there. They're visible in the community. They want their borrowers to do well. It will help their own community thrive. And of course, it will not look good on them if a business that they invested in locally doesn't do well. So they've got incentives in lots of directions. So that's great.
I think they can actually have an appreciation for a unique deal structure and move faster, because there's kind of less hurdles, if you will. You can kind of get right to decision makers at these small banks. And we've put some interesting, kind of structures together that I think may have taken more time, or just a bit more back and forth with maybe a larger bank that had kind of more specifics on the structure they wanted to do. These small banks can be a little bit more nimble.
And you've seen that then multiple times.
We have.
Not just that first deal. Yeah.
We have.
Great. And is there anything more to say about the fact that they matched SBA terms without it actually being an SBA deal?
I think for us, we were really just kind of fortunate that we were open with the bank at the front end on, like, we've got a few different processes we're considering, and one is SBA, and outlined what those terms were, and they kind of took those as terms they had to match in order to be at the table. And so it just worked out well for us that the SBA terms were, somewhat friendly, if you will, in terms of duration and covenant light. And so I think it just came from, they hadn't done a lot of acquisition financing before, and they kind of knew we were working a few different paths, and they wanted to be a part of the deal, and they matched those terms. Yeah.
They matched the PG too, didn't they?
Of course. Yeah.
For the good and for the bad. Okay. Very interesting. Thank you, Eric. Okay. So now let's turn back to LK Industries itself. Sure. If you could give us the numbers around the business and, kind of what you liked about it, what you maybe didn't like about it.
Yeah, sure. So top line, the business did a little between like 6 and 7 million of revenue. So, and they had about a 25% EBITDA margin. And so we had a good entry multiple there. Recalling this, it was like, I think a little over 3 times that we were able to get the entry multiple at 3.5 times. So it was a pretty good entry multiple there. Let me point out that this is part of buying a business that has cycles. And so that entry multiple is based on kind of where it is now, anticipating it might move in the future. So
important point. Thank you. Good call out.
And so for us, I think the business, kind of when we bought it, one of the things that was, really looking back, I personally wish we had understood a little better. One of the things that we saw early on was it looked like the business had a lot of recurring revenue, and they had the same kind of set of customers that were buying this kind of fixed sum of product every year. And you could just kind of see that perfectly all the way through the last few years of the financials. And what we learned kind of once we got our arms around that is that a lot of this was more project based than we thought. And so some of these projects were multi-year projects. And so they would buy 100 of this unit over 5 years. And so when you kind of look at that, it's easy to look at and say, oh, they must need 20 of these units every year kind of going forward. And it's like, actually, once the project finishes, it may or may not need more. And so I think we kind of learned an important difference between, I guess, maybe like revenue that repeats versus true recurring need. Yeah. And I think that was something for us that we learned and navigated through. I think another area of focus for us was understanding that in these businesses, managing inventory is very important. And so, because we're a manufacturing business. And so coming in and kind of understanding like historic inventory levels versus kind of more like just in time sort of manufacturing and kind of what you wanted to hold going forward actually was an opportunity for us to really improve the working capital in the business, to try to really right size the inventory for expected demand. So that was kind of another opportunity to reflect on and kind of get right. And something I've seen over and over, just, how much kind of inventory analytics you can apply to some of these small businesses, I think is usually an opportunity as you come in to buy one of these companies.
So what is the owner, doing wrong that you as searcher can come in and improve that they're not doing just in time, and that they're holding too much inventory, basically?
That's a fair way to put it. Although I don't think it's completely irrational on their end. They've kind of lived an existence where, they don't want to run out of inventory. So sometimes they buy large quantities that they can get a discount on, multi-years worth of inventory, and they stock it. And so I think just kind of depending on what they prioritize in their business might be different than what us as like a leveraged buyout might prioritize out of using cash. And so moving away from buying 18 months or 24 months of a product to put on the shelf to buying more in 60 and 90-day lots sort of thing for manufacturing.
Yeah.
And also, I think obsoleting inventories and other things. So we've seen a few times where product lines get discontinued, but a lot of inventory still sits on the shelf, being very particular about obsoleting inventory, selling things off when you're not going to use them anymore. I think it is a way to create a change in working capital.
Mm-hmm. It's interesting, Eric. We just did a webinar yesterday with Heather Anderson and Chris Williamson at Cane Crossing about working capital and small business acquisitions, talking about this very point, inventory in a manufacturing context or not, but any inventory business, and how there is a temptation among searchers to come in and say, oh, this owner has held too much inventory, and we can reduce that, freeing some of the working capital. But what you have to be careful of is exactly what you just touched on, that there may be a method to the madness. They may have all that inventory because they buy it at a discount if they kind of overbuy. And so if you reduce the inventory and buy less, you're not going to get the same margin on those inputs because you're going to have to buy at a higher price, as an example. So you just really need to interrogate it before you just assume you can make working capital improvements. Fair?
Yeah, that's a fair point. And I think you have to live it. Now, that's not interrogating it, living it's another way to say, like, you can have some thoughts on day one, but you have to live it. And I think some of the other things that we learned by living it was that, there are times where you can find a new vendor for things, and it's worth it. Sometimes there isn't a new vendor. And so you have to kind of live through that struggle. I think another area just to touch on is continued inventory management is also, I think a lot has changed in supply chain over the last few years. And some of it's been difficult for companies, and some is kind of bringing new opportunities to do a lot more like sub-assembly. So you have like partners that build, the first half of the unit for you and then send it to you in chunks. So a lot more like outsourcing of certain manufacturing needs, I think, is something that we're seeing as actually driving efficiency in our businesses.
You had said $6 to $7 million in top line revenue, 25% margin. So we're talking well north of $1 million of EBITDA or SDE, which is, of course, what every searcher hopes for. Although you did have traditional search fund economics, so you were probably looking for a larger business than a self-funded searcher today would. But then you got a great multiple. However, that multiple was so good because there was that revenue might not stay at $6 to $7 million, depending on where you were in the cycle. And I think you hinted earlier that in fact you get in there and revenue does start to dip pretty quickly.
It did. So we had kind of a down cycle hit in 2016, kind of 2017 timeframe. So it was actually pretty shortly after we closed. And, we had to go through the kind of standard playbook of things you have to do when that happens, which is reduce staff, kind of optimize everywhere you can, do your best to kind of stretch working capital. So, ask your vendors to give you a little bit more time to pay the bills and, manage through that. I think in the industry, that's pretty normal. And so there's kind of like, you're calling that vendor and other people have called them too. There's kind of, they almost give you a standard answer. We can move you from 30 to 45 days. That's it, that sort of thing. So there's kind of like some standard answers, but we had to go through that. I think the hardest thing for me as a young owner was understanding like what can we cut in terms of like personnel and kind of knowledge within the company. And so I really had to depend on some of the employees that had been there longer to ask them, when the business was smaller, how big was this department and how much did you need, kind of these different skill sets. And so we had to, go through that. I will say, fortunately, we did not have any sort of issues with our bank. We were able to kind of manage through, continue to pay our debt service. We didn't have any challenges there. And I think ultimately, as we gotten out of that cycle and it started to pick up, coming into 18 or so, we had a chance then to really rebuild in a way that we were going to own how it rebuilt. So deciding where are we going to put the resources as the business starts to grow? What are the, sets of, what are the positions that we're going to bring back, first, and really got to rebuild and be stronger on the other end of it. As we recovered, we did it with less people. So the revenue started to approach that same level again right before we sold. We were able to do that with less people, which ultimately helped efficiency throughout the company. I talked about doing an acquisition. We did that acquisition in 2016. So kind of as things were slowing, we decided to kind of go more into the business and acquire this calibration and testing company. And that didn't bring us a lot of employees. It was a pretty small kind of business that we bolted on. And it wasn't a lot of revenue either, but it really changed the capability of the company in terms of being able to have a whole nother product line in testing and calibration. And that was, I would like to describe that as some sort of master theme that I had, but it was actually a little bit of good luck, right? We ended up getting to know that company. They told us the owner was going to retire. We were able to buy it, but that really shifted our business to being a lot more on the testing and inspection and calibration, which had a better multiple once we decided to sell. And so that was a win for us to be able to bring that in. It gave our people like really something to focus on, as the business was in some ways like having less demand of its core products. We had a new service line that could focus on that was somewhat more insulated from cyclicality and able to really build that into our kind of culture and into our business going forward.
Fantastic, Eric. That was great. And I want to hear more about testing, inspection, and calibration and why it's a hot area today. First, how old was LK and how many employees did it have when you bought it?
LK was founded in 1930. And so when we bought it in 2015, it was 85 years old. And
Wow.
We've got a 100-year anniversary coming up of the company soon.
I love it. Great. That's so cool. Yeah.
I'll have to think from memory here. I think the company had about 33 employees when we bought it. And it's still owned the company today. It has a lot fewer employees now, but it had about 33 employees at the time.
Okay, great. And when this cycle, the down cycle started, you've told us kind of how you managed that, but just kind of emotionally, how
Sure.
bad was it?
Yeah, I think, emotionally, kind of the hardest moments are coming in there and having to let people go. And I think, sometimes we can do these analyses on the computer and it's kind of very clear. You got to get to a certain number and this is how you get there. But I think, when you sit across from someone and you've got to actually make that change, it's hard. And I think it's okay to talk about that. There are emotions in doing that, changing people's livelihood and having, to have that tough conversation. So I think, that was always kind of first and foremost, the one thing that I think was always hardest, was having to let people go who it wasn't their fault, right? I mean, the business had just changed. They had done a good job for us. I think the other emotional aspect of it is there was a lot of really good ideas that we had that had to find their way to the shelf. There just wasn't the cash to do it right now. So some kind of new marketing ideas that we had or kind of new products that we wanted to spend time building, just had to wait until the business recovered. And I think that was hard too, because, 27 at the time, 26 years old at the time, I've got a lot of energy behind wanting to do certain things. And, you just have to wait until you have the resource to do it. And I think, that was interesting to kind of see how that played out. Some of those ideas ended up being able to be implemented later, which was nice, but, certainly it was hard to kind of see them have to wait. And then I think the other emotional aspect of the business is it just takes a lot more of your time as an operator when that happens, right? You have to get there a little bit earlier, work a little bit later. Every opportunity that comes in from a customer is one that almost feels absolutely vital. And so you're really working hard to make sure you're getting every bit of revenue in the door that you possibly can. And I think as an owner, in some ways I look back on it as probably maybe a silver lining, being I had to learn that business probably faster because of the pressure that was happening. But it weighed on you. Fortunately, I didn't have kids at the time. I could put a lot of time into the business. It was just, I was able to really run with it and, devote the time to it that I needed.
And you said you were in your late 20s.
I was. Yeah. We closed on the deal at, I would have been like 28 when I was running the business.
Okay. So you're in your mid-late 30s now.
Yep.
Great. And before we turn back to TIC, anything more to say about your background as an engineer? You had said at the top that has been really great
I'll
for
emphasize in that role where I was running an oil and gas related company, that was a product business. Being an engineer, it gave me a lot of credibility with customers. And so I was selling to a lot of oil and gas companies, a lot of pipeline companies. So the buyer on the other end was usually similarly had the same education. They were also an engineer, petroleum engineer. And so I think, that's kind of a learning I've had. It's like, if you can hit the ground with your business and through your background have like a way of having credibility with the customer, it goes a long way. I could often say things like, I've been in your shoes. Here's why I like this product. And that really helped. And so, as the CEO of a small business like that, you are the chief sales officer as well. And so I think really getting in front of those customers and them understanding that you can look at it through their lens helps with wins in the business.
Yeah. I'd say that's an example of some business buyer fit, as we affectionately refer to it. So you buy the testing, inspection, and calibration business. It sounded like not through some grand strategy, but because it kind of, the opportunity presented itself. Exactly. It was very small, little bolt-on you could do. But come to find out that it is opening up an entirely new market in business line for you that actually has pretty appealing characteristics, maybe even better than the business number one. Tell us more about just the business of testing, inspection, and calibration, and why private equity and searchers like it so much today.
Well, I think, first and foremost, those businesses have a real recurring revenue stream. They have a customer set who has to have their product calibrated or tested annually or based on some regulatory requirement quite often. So there's a recurring need from the customer's standpoint, which is great as a business. For that, so that was really something that was important to us because we wanted something that didn't have a cyclicality to it. I think also we got into a few different industries. So the majority of the company that we bolted on, his name was Miller & Weber, was in oil and gas, but they also serviced the medical industry and the food testing industry through its lab services capability. So that got us into a few different industries as well, which was great. And I think the reason, you kind of continue to see a lot of focus on this, and we focus on this now too in our kind of current existence of TXE, is that it's been largely fragmented for a long time. There's been a lot of smaller labs, a lot of smaller testing companies that can do this work in their region. And so, that makes it appealing that there's just fragmented, there's a recurring revenue stream. And I would say one of the things that we kind of like about it is like there's a technical nature to it. We like that. And so you can really kind of build expertise in your area. That cuts both ways because sometimes you have key personnel risk when you buy one of these businesses. And so you have to really kind of understand that. But once you're kind of in the space, it becomes a competitive advantage because you start to understand the technical aspects of that industry really well and makes you a good buyer for more of those going forward. So we bolt on this business. We have to actually relocate the lab facility into LK's current facility. So we did a full build out of a new testing lab, relocating the equipment and getting everything set up, and kind of building it into our facility. And ultimately, we had some customers who were buying from both LK and Miller and Weber, and so we got a larger wallet share of some of those customers, which was great. So they started to look towards us as not just a product company, but a service company for them, and that led to more opportunities because we were doing a lot more business. In fact, there's one super major E&P company that we work with even still, who that relationship really took off by those two things coming together, and that turned out to be really important for us as a business.
Mm-hmm. And so then, did you start growing Miller and
Weber,
Miller and
Weber,
Miller and Weber, and getting into these other, like going full throttle into some of these industries that it was already in?
We did. And so I kind of have to talk about this in like two chapters. So there's like the chapter up until the point I sold the combined companies, and then I bought those companies back recently. And so we're still kind of in it, but kind of up to the kind of in the first chapter, we really focused on integrating Miller and Weber in the oil and gas side. That was really like important for us because that's just where the bigger dollars were. And we really wanted to spend our time getting that right. Today, Miller and Weber still exists as part of LK, and we have a lot more work on the food processing side that's just turned out to be a really big growth sector. There's some regionality to that, in terms of where you're located can drive kind of where your customers come from. But, we have built kind of an expertise around being able to do certain kinds of calibrations in these industries and within these customer sets. And it's nice it's almost clockwork. We can kind of say like, these will be the sets of customers that come to us every June and every July of every year. And that's, that's nice compared to an oil and gas business.
Yeah, absolutely. Great. All right, Eric. Well, let's start closing out this chapter of your story with LK. As you said, you're now owner of LK again, which is, we'll get there. But let's close your kind of first search story out with how that ended. And then, because we got a lot of ground to cover on what you've been building since TXE. So tell us about the exit of LK.
Sure. So we sold the business at the end of 2018, and we sold it to a private equity group out of New York who was investing in kind of everything that LK did on the gas side. So we were in a lot of our products service the oil part of the oil and gas industry. This private equity group was trying to build out a thesis on testing. And so we were a fit for their portfolio because we brought in kind of another half to what they were doing. And we were not for sale per se. We were, naturally when you do a search, there's an exit somewhere down the line, but we weren't actively marketing or looking to do anything in the immediate term.
And it had only been 2-ish years at that point.
It would have been closer to about 3 years. So we bought it in 2015. We're talking about mid-year 2018.
2015, yeah.
And so when we got approached by this, we kind of grouped up, me and Rick Royce, and talked about, could this be the right time to exit? And I think we were all of the opinion that it very well could be, because we had come out of the industry, dip. We had fully integrated this Miller and Weber business by now. And so this was kind of the earliest we would want to have anyone take a look, at the business because we were, it was doing reasonably well. And so as that process unfolded, it turned out that, kind of from our perspective, this felt like it really fit in well to the private equity group's platform company and what they were doing. And we, made the transaction, move forward at the end of 2018. And then I stayed on with the private equity group for about 1.5 years after that. And in that role, I was helping to tuck, my business into their business, training my replacement, and then helping them do some stuff across the whole platform of companies that they had. That was actually a really, fun experience. Certainly I didn't know that would be something that the exit looked like. I didn't know it would look like that for me, that I would sell the business and then have an opportunity to work in this private equity group and get to, see kind of a different side of investing. That was a fun opportunity for us. In terms of an exit, I think the business did, I think it did okay. It was certainly not the, largest exit by any means. We were able to get a higher multiple at exit because of that TIC affiliation that we had in the business, but the business had dipped a little bit from what we bought it from in terms of EBITDA. So we were able to get double-digit return on our proceeds from it. I was able to do well, personally. This was still a good exit, and that exit actually helped set me up to be able to launch TXE version 2 going forward. And so, if you did the math on, we sold it at year-end 18, and a year and a half later, I left the private equity group. We're talking like right in the middle of COVID is when we chose to launch TXE version 2, which I'm happy to talk a little bit more about. But certainly that exit was something that, turned out to be a good fit in terms of timing, and a good fit in terms of giving us a chance to put LK into another, growth partner as it would go forward.
Yeah. Well, I'm going to offer that maybe the private equity's vision didn't come to pass if they have now sold the business back out of their portfolio. You'll correct me when we hit that point in the story if I'm wrong. But that was fantastic, Eric. So tell us then, after your exit, after your stint with the private equity firm, what was the vision for TXE? What was that pivot in your career all about?
So because of the taste I got with Miller & Weber, I decided I liked the testing, inspection, calibration sector. That's where I wanted to spend more time investing and operating. And so in launching TXE version 2, the thought was, let's attack that sector. Let's find opportunities in that sector, and for all the macro reasons I've kind of alluded to, the recurring revenue, it's fragmented. We have an understanding of the space. So started to look for those opportunities. Did the first acquisition shortly after launching at year-end 2020 of a company called Atlantic Product Services. That's a business that was based in the New Jersey area that did testing of petrochemical products. So kind of got to marry a little bit of both, the background there. This company would actually take products that came in through the port, take a sample of it off of a barge, run it to the lab, confirm that it met spec before it was offloaded into the port. And so that was a business that we found through I guess I'll call it like a network search, if you want to call it that. I had gotten to know that business and business owner very briefly, kind of during my time of working at LK. And then in 2020, learned that he was interested in selling the business. And so it turned out to be something we could move forward with.
Other than your TIC thesis, what were you trying to build? A Holdco, a roll up? What was the kind of larger vision, or the structure maybe?
Sure. So a larger vision there was to acquire multiple testing companies and to build them as under a Holdco structure. So to have several of these smaller testing businesses. We weren't at the time regionally focused. So we did one in New Jersey, as I mentioned. So looking at anywhere in the US and looking at industrial testing. So didn't want to go necessarily into healthcare related testing or even FDA related testing. Wanted real industrial testing. So petrochemical related, water testing, kind of, machinery testing, kind of things that would be all more in the industrial sector.
Why did you like industrial more than health or FDA?
Because the regulatory aspects of healthcare and FDA are something that it's quite the learning curve. So to climb that, to be able to become an expert in it, we thought would just maybe slow down our ability to transact. And we had built some expertise on the petrochemical side and on the chemical testing side. And so we kind of thought, let's start there. But the concept being, rather than try to have a portfolio of just a lot of varied companies that maybe are loosely associated through testing, inspection, and calibration, really wanted to have a set of companies that could be thought of almost as different divisions within one organization. So there's a division that does the oil testing. There's a division that does the water testing. There's a division that does air testing, whatever the different kind of parameters would be, and wanted them to have an ability to be thought of as more of a full service testing operation as we approach customers. So, we can do the following sets of tests for you through our sister companies and our affiliates. So that's kind of how we wanted to start. And was it to buy and hold, or build this vision and then have an exit? So it is definitely with the buy and hold mindset. And that's, holding we think can create kind of long-term value, because we're buying, micro-sized companies. And if we put enough of them together, we can become a little bit of a bigger company, but that'll take time. And so really holding these long enough to get a true integration, kind of a true build out of the thesis. And, at some point down the line, see if that as a whole might be, something that's marketable. But I think in the individual kind of choices that we make every day, it's around holding these for 10 or more years. It's around making decisions where we can be really long-term holders in what we're doing. And I like to say we want to build a business that other people want to buy, but we're not necessarily looking to sell it.
Sure.
Continuing to stitch together these things, we have some unique ways of sourcing, which AI has made a little bit easier. But back then, as we were kind of doing a lot of this very manually and trying to understand how to filter for high quality laboratories, look at labs that had accreditations, labs that had key sectors they were servicing, and trying to build those out. So we launched that in 2020, did our first acquisition then, and then have since bolted on a few more companies, including buying back LK Industries, which is a fun story to elaborate on, but have continued to add more testing companies and are out looking to do even more of that as we go forward. What has changed slightly in our approach is that we realize there's some good opportunities for not just looking at purely testing service companies, but looking for companies that also make testing products. And so we look at both the true service side and then also like a manufacturing aspect if it's servicing that same sector. So we using our manufacturing background, have been able to find some unique opportunities there. And then the other thing we've kind of pivoted on is, although we still have, somewhat of a interest in looking broadly, we see that most of the deals we're going to do are probably going to be focused on kind of southern, kind of middle U.S., so really kind of drawing somewhat of a regional aspect to what we're doing. And then lastly, we evolved to see a shared service aspect, services center that we want to offer across our companies, and happy to elaborate a little bit more, but that is something that came kind of as an evolution of TXE as we went forward.
Great. Yeah, we are going to hear about the shared services there just in a sec. But when you said AI has made searching, I guess, easier, can you elaborate on exactly what AI would do today versus what you guys were doing manually just a few years ago?
Yeah. So, I vividly remember kind of in the early days of running TXE, going through and, manually scraping a lot of data on trying to get the, based on like the accreditations these labs have, they're listed, and trying to really, manually find owners and owners' contact info and pulling a lot of that. That same exercise can be done now with an instruction to AI, right? So pull this information, summarize it. And so I think what it's done is just made our ability to navigate those channels faster. And, before where, work stream might feel like something an intern could do, or something that, you just really needed someone who could be behind the screen, you can really get that done kind of automatically. I will say it's a tool. It doesn't kind of fully fulfill all the needs of how you search, but it is a tool to give you a lot of that info and filter it for you on the front end. And then, we still very much believe in like high touch sourcing methods. And so going quickly into finding out, can we connect with these business owners, not necessarily with the TXE hat on, but with the operator's hat on from one of our fellow companies. And that's been a good way to connect, because sometimes these owners are not ready for a call from a fund, or ready to have a call with the buyer, but reaching out as their colleague that runs a very similar business in Houston. That's a very effective way of talking just owner to owner about operations, businesses, and kind of building that rapport. And, over time, that leads to a set of conversations that may allow a transaction to take place.
Yes. We hear that theme or see that pattern a lot, that sellers, owners that you might want to have conversations with, if they see you on the other end of that request as a comrade, as a fellow owner, it's much more effective than seeing you as a searcher or as a private equity guy or as a fund or what have you. Great. Thank you. This shared services model. So just to set the stage there, that shared services versus decentralized kind of services, where in a Holdco situation where every business is really self-contained and doing its own marketing and finance and back office, versus a shared service where some of that is pushed up to some central management. This is something that is always a kind of a philosophical talking point in Holdco land. Warren Buffett and Berkshire Hathaway famously are pro-decentralization. So all of their businesses are very self-contained. Of course, they're enormous businesses, so maybe that's not a really analogous. That's not so analogous. But you will see shared services versus decentralized talked about a lot. So you have embraced shared services. Please tell us about your model.
Sure. So, our observation once we had, 3, 4 companies kind of in the portfolio was that, none of these companies had a marketing person. It's a good example. And, that full salary burned on any one would be meaningful. So we kind of observed could we keep a marketing person busy across 4 companies and then allocate the cost to each? And so I say that to recognize that we didn't get to shared services because we had a thesis on it. We got there through true operational, kind of observing what the operational needs of the businesses were and recognizing that we're buying a lot of small companies. And so the ability to add overhead to any individual one is not necessarily easy. And so what we have found, and I've seen the shared service model in other ways, be used, but what we have found that's really important is that one, we don't overbuild the shared service offering. And so, we're not going to reach the point where we have a lawyer on staff. We don't overbuild it. We really do is we think about what are kind of the core needs that most businesses are going to have most of the time. And that's, from our opinion, that's marketing, that is finance and accounting, that is HR and recruiting. Those have been kind of the handful that we really see are kind of a recurring need in a lot of the businesses. And when we kind of took pencil to paper, we were looking at recruiting, for instance, where we had an actual recruiter that we were paying to help staff positions and whatnot. And we were like, that's, there's a good amount of money going there. Can we insource that? And we had a marketing firm for a while. We were seeing how much we were paying. So these have been services that we were kind of paying a third party for when we decided to bring in. And what we have found is because of the nature of the businesses we're running, they're very technical. They have a lot of nuance to them. To be really effective at some of these services, people have to go deep into understanding the company. And so I think for us, it makes a lot of sense to have these people that can really understand our product offering, really understand our niche, and then use that understanding to effectively provide services to our businesses. So I think we think of it as, yes, they're small companies, so they can't afford these necessarily individually. This is a niche industry that we're playing in. So we want people to really go in depth and understand our businesses. And we're only going to add shared services for business needs, which are kind of common and recurring often. And so we have preferred partners for legal and for insurance and kind of other things that we will, still work with the third parties, but we really want to make sure that we're tailoring our shared service group just for those recurring needs. Let me also say that I think it's really important to note what we don't want shared service to be is just another name for some sort of corporate headquarters, right? And we're trying very hard to build a culture around saying our company presidents are our clients for shared service. When you as a marketing person, you as an HR person are engaging with that company president, what they need is what you have to prioritize. And so really kind of reversing this model of the accounting group is here to help the portfolio company, not get reports and data and, demand things from the portfolio company, and really try to build that mindset to where everyone understands this is a support service that's being offered to help our companies. Interestingly, we've seen the effects of that in our operating company, but we've also seen an effect in how we source deals and how we can talk about our shared service with potential sellers that was maybe a little bit unanticipated, but has certainly been effective. Let me elaborate on what I mean by that. So as we talk to a potential seller, the potential seller is, maybe retirement age. They may or may not have an heir apparent in the business. So sometimes they're kind of concerned about what does the next chapter look like? How does the business continue to run? And we can kind of put right on paper, here are all the services that we can take over day one, all the things that we'll have kind of integrated from our shared service group, so that as we're thinking of whoever is going to replace you as the future leader in the business, they don't have to worry about those things. They can just worry about learning better the technical side of the business, learning better the products, learning better the customers, those things that are kind of most important to the skill set, and all the ancillary stuff that you, Mr. Owner, have been dealing with over the last several years on approving payroll and having to work with the CPAs on taxes. That's all done kind of by our back office. It's been an effective tool to differentiate ourselves and to also give sellers a way to better realize kind of what the day after selling looks like for their company.
Well, Eric, that all sounds fantastic. And often you'll hear people say that shared services sounds great in theory for many of the reasons you articulated. Just to press on this, what are the reasons that shared services fail, to be clear? What are the reasons that they fail, and how have you dodged that?
So 2 points that I'll kind of just reiterate. One is when they add too much cost too quickly. So they go through and say, we want to get every possible shared service in-house, and like, let's do it immediately, and then burden the companies with the cost. So you build it too fast. That's one.
Okay.
Second, this mixed culture of trying to be headquartered versus actually support to the companies, I think can be really difficult, because then the opcos start to not feel that they can be really honest about what they need help with, and start to feel like they're having to do work for shared service, which is not what you want. I think the other piece is, and this is something we deal with, currently, is that business needs ebbs and flow. They have ebbs and flows. And so there may be times where it feels like a lot of our shared service bandwidth is going to one particular company, this week or in this day. And it's, reflective of maybe that company has a conference coming up, or they're growing and they have 3 or 4 new positions they're trying to staff, or they uniquely had an HR problem. And so at times it can kind of feel like the shared service is spending more effort in one place and not in the others. And I think that's something you do your best to manage, but you also have to realize that will never go away. Like, certain companies will have more needs than others at different moments, but really watching that, I think, is something that can be really hard if you're not cognizant of it, because certain companies will, as you buy them, particularly new companies, they have a lot of need up front to get set up and established. And so I think just being very clear about ensuring that all your companies feel like they're getting value from shared service in a somewhat fair manner between all the different portfolio companies. It's been another thing. And then lastly, I'll just say, it takes me as where I sit, I spend a lot of time in operations. And so in some ways, the shared service center is almost another business to manage. And so it just takes the bandwidth of management to understand, like, what are the performance metrics for shared services? What are the performance metrics for OpCo 1, OpCo 2? And how do we ensure we're kind of all performing optimally?
Mm-hmm. And Eric, what about the critique that each business knows what it needs better than some shared or centralized resource would? Marketing might be a great example. So your marketing, the instinct of what communicates the value proposition is going to be strongest within your opcos as opposed to centralized. How do you address that?
Fair enough. So what we don't do is we don't necessarily create like the marketing materials and say this is from TXE when we're advertising it. We work with that company president to what does the customer want? What are kind of the materials that are needed? How should we, what is a good approach? And we do all that, and we do it under the umbrella of the OpCo. And so from the outside looking in, the customers or the kind of industry shouldn't even see that there's a centralized marketing. It's all being done in the company. We're working very closely with those company presidents because, to your point, like, we want to just be helpful. So we're going to take guidance from those company presidents. We're not going to direct it. We're going to certainly share best practices, but maybe a very tangible example of like how you do that is we're not going to tell them what trade show to go to, but when they tell us what trade show they believe is right, we're going to do a lot to make sure they have everything they need, the social media post on it, all the booth materials, everything they need. And if they want someone there from our marketing team, great, but they won't be there by themselves. We have to have employees from the company there because they know the industry, they know the business.
Yeah. Great. Eric, thank you for that walk down the TXE model of shared services. Really powerful stuff there. Okay. I don't have you for too much longer, but still some topics I really want to get to here. Sure. Heard you refer to yourself as an operator. One really interesting thing that you said to me in our pre-call is this question you ask yourself: do I want to be an operator or do I want to be an investor? What am I best at? How do you think about that?
It's something I feel like there's tension around at different moments. On a personal front, I think if I kind of observe where I spend my time, I like being an operator. I like being at the companies. I like working closely with our personnel and our businesses. And so I'm kind of being realistic about that. I like being in operations. However, with this kind of model where we're building out, having several companies, that becomes harder and harder to do. And so I think the realization of like the direction we're going will require me to be better at investing and kind of looking at transactions more than being in each individual deal. I think it's kind of what I'm starting to realize. But I think one of the things that we feel somewhat fortunate on is like, TXE doesn't have like a fund that's dedicated or has any sort of time specificity around how we have to do deals or how much money we have to deploy, so we can kind of move at our own pace. And I think in some ways that allows us to understand that there's an operational issue or an opportunity that we can say we're going to probably spend a little bit more time in the companies than working outside the companies. And so that is a little bit of a benefit on how we can operate. But I think the thing that I keep thinking about is, with these small companies, do you ever get too far away from operations? At a certain size, you probably have a COO in the companies, or at a certain size, you have a whole set of people focused on us. But when we're talking about, small companies that are 15 or 20 people, a lot of times there is a need for more operational involvement, and to really help and be partners to some of these businesses, particularly as I touched on, where there might be a new executive taking over, or like a new president taking over after a retiring founder. And so, this is a long way of saying, I think the reality of this is that tension. It's, with these small companies, we're probably going to not be always too far from operations, but as we have more of them, it'll be harder and harder to do. And so I hired a team member who sits at the TXE level with me, who's working on what we call strategic growth. And so bringing in a partner, someone who can work and be at the companies working on particular projects, but doesn't have to use all of my time to be at the company, so that I can continue to work on build out. And I think that's a realization of like, I can't, necessarily have more than one of myself, but I can start to put team members who can support these companies in the right way, so that we're, as TXE, still close to operations, but not fully engulfed in them.
And what is that person's title?
Manager of Strategic Growth.
Manager of Strategic Growth. Great. And we didn't define the size of businesses that you're acquiring into TXE. We've heard you say now that there are 15, 20 people, that they're quite small. So please be explicit.
Yeah. So we are looking at companies that will do anywhere from about $750,000 of EBITDA to probably about $1.5 million. There'll be some a little bigger that we might look at, but we think that sweet spot is on the lower end of the market. That's where we see a lot of opportunities for these testing laboratories, and where we think, I'm talking about EBITDA when I said those numbers, but where we think that they're a good fit. And, why is that? Some of this is, I'm sure, things you've talked about before, but there's not as much competition in that lower end of the market. We also think back to the fragmented aspect of the industry. We can see a lot more, and we've built, an expertise in our niche. And so these businesses that often have a key man risk to them, we can have some confidence that we can go in and understand the business because of the other companies that we have. We've kind of learned a particular industry. So that being said, we have businesses in our portfolio that are bigger than that range I just gave you. And so, we kind of, we take the opportunities as they come, but we think buying in that range is right for us.
And why, Eric, is buying larger not right? Why is that outside of the sweet spot? Buying a tech business with 2 million, let's say, of EBITDA? Why is that?
Generally speaking, it's because we see upmarket competition, right, from other buyers. And then two, if we get too big, just take it to like the extreme one that's 3 or 4 million of EBITDA, they're going to have a lot of the services in-house that we're trying to offer. And so at that point, the shared service model doesn't work. And so it's very specific that these things work together, because we're buying small companies that don't have this infrastructure. Shared service adds value, and making sure that we kind of play in that space to ensure that, we're not duplicating costs within the companies.
Yeah. Well, at 750 to $1.5 million of SDE in a tech business, I bet you are competing with every searcher in the world, because that
we do bump up against searchers. Obviously, we think we could differentiate just based on experience and kind of deals that we have. And so a lot of what we're doing is, we do see searchers, but honestly, it's, as I think about it more, it's not that often, because we're doing a lot of deals that aren't even on the market. So we're talking to our peers that are running other companies and telling them our story. And a best compliment I got is there's one company in the Northeast where the owner told me, I'm not ready to retire yet. He said, I'm probably going to work. I'm going to die in the office. That was his joke. But he goes, there's a list of potential buyers in my desk drawer, and you're on that list. And so he's like, my wife knows to open that door if something happens to me. And so a lot of what we're doing is putting seeds out there for deals that we know are just not necessarily with the broker getting marketed, and we'll handle those if they come up. We want to have a good reputation in what we do and have owners think of us as a good next step for whenever they decide to sell their business.
Well, that's one of the benefits too of this long-term horizon that you have, not having raised a fund where the clock is ticking for you to deploy capital. Also, searchers whose own runway is a ticking clock. So searchers need to move. They can't just wait around for hoping the seller is ready to sell. So great advantage that you have with this long-term perspective or approach.
And I'll touch on one more thing. So relatively new announcement for TXE is we added an operating partner here recently, actually on Monday of this week, who is in a different region and is looking at businesses in our same kind of sector, but basically wants to be the CEO of the company and after it's bought. And so we look at that as kind of a new evolution for TXE as well. Can we find the right operating partners who we can help source a deal? But we need an operator, and we're not, if the business isn't in Houston, we're not going to be able to be on the ground. So we need an operator. So really excited to kind of see how that evolves. But again, it requires that we're looking at kind of those smaller businesses who are probably going to have an owner operator stepping out after they sell. We have to put someone immediately back in. And so I think we're going to keep looking at these kind of different opportunities, but this aligns to shared service because that operator, once they step in, wants to have the backing of TXE to kind of help with everything that happens in the back office there and allow this new CEO to just be focused on customer operations and sales. And so that's been a new evolution to our business as well.
And was that operating partner a searcher or somebody from ETA land?
It is. Yep. So someone who had approached searching before, stopped, and then kind of, I guess, getting back into it in some ways, but with TXE.
And they have an equity consideration, presumably, in the business that they find for you.
Absolutely. In fact, we'll look very much like co-investing together. So we'll put the structure together, and then that individual will be able to bring as much capital as they would like to the table alongside us to actually make sure they have a good amount of upside. Because we are looking at these small deals, there has to be enough upside for everybody. And so that's why we think co-investing makes a lot of sense.
Mm-hmm. Well, for many of the quote unquote holdcos, for lack of a better term, in this world, this is one of the key bottlenecks to their growth. Is once the deal flow engine is in place and the reputation is established of the holdco, who's going to run these businesses? Who's going to deal with all this deal flow once we close on these deals? And figuring out a way to hire CEOs of these very small businesses is part of the art of doing this well. Chenmark, of course, is the kind of canonical example. You've probably heard their name. And they have a kind of a similar, they look in the search community and the ETA community. They speak at the conferences precisely to find folks who might be doing their own search, but see an opportunity to run a Chenmark business, search for, in fact, alongside Chenmark or with Chenmark for a business to then be the operator CEO of, has been a model that appears to work for them. And they're certainly not the only ones. And it sounds like, did you come up with this on your own, or were you looking around our ecosystem at other models that seem to work?
No, this came a little bit opportunistically. And so basically had a colleague that I'd known for a while saying that they wanted to search again, and they've got a lot of experience, kind of working directly in industry, and so we saw that as I think we could help each other. We need good operators, and the infrastructure to help you search, and so I think this is something we might see ourselves doing again. But we're not really. I think as I think about it, we're not necessarily going to a searcher that's right out of business school. We're actually, I think, right for the mid-career person that decides searching is something they want to do. So they've come with some capital that they're interested in deploying. They have, some expertise, and the infrastructure we can provide just helps them get to the deal faster because we have a good sourcing mechanism and can put more in front of them. So, taking 2 years to search is kind of hard to do mid-career. And so we can help them close in, 6 to 9 months on something because we have a good pipeline. I think it's a win-win all the way around.
Mm-hmm. Yeah, that's great. We had introduced this concept as well of searcher in residence, Eric, which is not exactly what you're talking about, because you're talking about a true operating partner and I guess an indefinite partnership with this person who's going to retain equity in the business. But there are parallels. And the idea basically being that there's this profile person, many of them listening to this podcast who really just want to get into this world and run a business. And there are many flavors of doing that don't necessarily mean searching for and buying your own business, but maybe working with a searcher like yourself or a Holdco builder like yourself who's already deeply down the journey and somehow working, being brought under or along with you. We're starting to wrap up here, Eric, but let's hear just a little bit more about the structure of TXE and how you're buying these businesses.
Sure. There's definitely some overlap to like an independent sponsor kind of model, but we essentially take each deal that we find and we have kind of a small set of people who have shown interest in kind of co-investing with us. And so we'll negotiate the deal, kind of get our kind of capital structure understood in terms of how much debt we would have put on, and then kind of do a little bit of a pass the hat on for people that are currently working with us. So like some of my current entity presidents are interested in investing in a new deal, in a small piece, put personal capital in. And then we have, like I said, a few partners that are folks that have maybe, ran businesses early in their career and are now just looking to make investments, some family offices, those kind of conversations where we can go and just shop the deal. And so, no, I don't, as we go forward, I don't suspect any two deals will have the same capital structure. I think each one will kind of be marketed on its own. And what's been really interesting, Will, is like we have one deal we did recently where I know someone who invested in a business like this back in the 90s and was just real excited about, hey, this feels similar. I'd like to write a bigger check into this business than maybe the next one. And it was just an appeal to their personal interest. And so that's how we want to keep approaching it. I think from our perspective, the value, the trade-offs there are in a positive sense. As we get a better track record, we can negotiate kind of better terms from the TXE side going forward with each deal.
Yep.
I think too, when you have a high quality set of investors or partners that are at the table, you can raise the capital pretty quickly and feel certain that with a couple of calls, it can or can't do this deal. I think the negative trade-off is you do still have to spend the time, going out and shopping the deal as opposed to having like committed capital, ready to go. But we are able to move at our own pace. And I think that really matters for what we want to do. And it creates kind of a model for us that we think is somewhat differentiated in that we can say we can do a lot of deals, but we don't have to do any one deal. And I think that's important for us.
And what you're saying there is because you're going deal by deal and haven't raised a fund, so you're not under pressure to deploy capital from a blind pool that you have raised. Great. And just you said that no two cap structures will look the same on your deals, but they all do have, you said that there's a band there of 750 to $1.5 million of SEE, although I guess there's a couple in there that are a bit larger. And so I would imagine that the cap structures would be somewhat similar, that there would be a band there. How much leverage are you using? I mean, you could buy those with SBA loans, of course, then you have the personal guarantee constraints, and that probably doesn't work with your model. But can you share like how much leverage you put versus equity on these deals?
So we're trying to be heavily levered. So we're definitely over 50%, sometimes approaching 60% on these deals. And so the uniting element in all the cap structures is that the debt's a big chunk, maybe the biggest chunk on the cap structure. Where we try to get some seller, paper in the deal too. And then we'll raise the equity, for what's remaining.
Okay. Well, and when you say 50% or more of leverage being a lot of leverage, I guess you're comparing that to a private equity style transaction, because certainly for a self-funded searcher who will have 80% leverage or more, that's not a lot of leverage.
You're right. And you're hearing the characteristic of my oil and gas background where 50% is a lot when you're in that industry. So that's what's coming out there. But no, we certainly, we think of leverage as a good tool. And the nature of the businesses we're looking at with recurring revenue streams, we feel comfortable kind of pushing heavy leverage into these businesses.
And say a little bit, Eric, about the pitch to LPs when you invite them to participate in a deal, and specifically with the attention to the long-term hold here. as ourselves at Minds Capital investors in independent sponsor deals, we need to see a path to a liquidity event because of our own LPs. And so while I personally have an affinity for the long-term hold and like that, I now appreciate that isn't always viable when you're raising money from others who need to know, your investors need to know when they're going to see their money plus return back. It can't just be, well, maybe it can, but it's a rarer investor who's willing to go along on some indefinite ride. How do you position this to your LPs?
So we do screen, if you will, the investors that we choose to work with based on them being comfortable with the long holding period. When the actual question comes up of, well, what if the business grows quickly and we get a really good, offer on it? Would you sell? I can't say no, we would not, because I don't want to be misleading. Right, if the right opportunity lined up, we would consider an exit. But what we try to note is that we're going to buy and make decisions for the long term. So a good example of that, like one of our businesses, we bought the real estate because we needed, to really hone in on our manufacturing plant being in one place. So you wouldn't normally buy the real estate if you're a short-term holder, right?
Yeah.
And so we continue to make decisions like that, which are, we're going to operate as if we're a long-term holder. And if stars align to where something comes up that's economically rational to sell, we would consider that. But from an investor standpoint, they need to be signed up for the long term. And if I had a partner that said, I really do need to get out, we would work on, a pre-established structure for how to buy them out at a rate of return and kind of in a fair way, right? To make sure that we keep everyone that's working with us treated fairly.
But the pro forma that you would show a prospective LP on a given deal shows a particular IRR or MOIC based on a hypothetical exit, or is it just dividends that are coming out? Like what are the numbers that you show them in terms of what their return will be? Sure.
So we will generally show a return based on like a 7-year kind of hold, because you need something to be able to do that. But most of these businesses are going to be dividend based once we pay off the debt. So we think that's really attractive to show, like, the way we levered this, we can be aggressively paying off the debt and then have dividends that pay out over a long period of time. However, just, to have the right conversation, we have to be able to show different exit scenarios. But we really emphasize, if you will, the concept of we want these to be strong cash flowing businesses for several years. And the good thing about the companies we're looking at is most of the time we're buying from the owner. And so the look back is kind of representative of what we want kind of going forward, obviously with more growth. These businesses have long track records. They're not just growing overnight, if you will. They've been stable companies. And so there's good reason to believe that we can start to move these businesses up and grow them in a stable way for a long period of time. And that's another point of emphasis. Well, I think we constantly look at, can we hit a lot of singles and doubles in the portfolio, and ultimately that be a way to build a lot of value, get a lot of points on the board. And I think that's why we're comfortable looking at the smaller deals, putting growth rates on them that are maybe smaller than what other people might put on them, because we want a good portfolio of businesses that are slightly moving up and to the right over the long term. And I think that's that drives our decision making in what we're doing.
Well, the thing about singles and doubles is that when you add long-termism to singles and doubles, you get the wonders of compounding, and they can be very, very interesting. But you do need obviously you need the long-termism of singles and doubles to make that spectacular. But it is, it can be really compelling. And so your LPs are basically signing up for, sure, a liquidity event, if it makes sense, could happen. But really, this is a play to see dividends coming out, annual dividends coming out of these cash flowing businesses. And hopefully those dividends grow over time as your shared services model and your new energy is brought into these small businesses.
Exactly right.
Last question for you, Eric. The story of the reacquisition of where you started with LK, or what happened there?
Yeah, so that was kind of an unexpected outcome that came. But as I mentioned, this private equity group bought LK and built it into a part of a platform investment that they had. With COVID, they decided to kind of change strategy. And so they ended up selling the platform business and sold it in parts. And one of the parts was LK Industries. And so I had maintained a good relationship there, kind of got a call back that they were going to go to market for these handful of different businesses that were all part of this platform. And that if I wanted to be on the buyer's list, I certainly could be. And so I said, absolutely, would like to be on the buyer's list. And as the deal went to market, it was mass marketed, with large independent, investment bankers were marketing the deal. And so LK Industries turned out to be one that I understood quite well. And so I was able to kind of put in a bid that I think reflected that I understood the business well. And as they ended up selling the different companies, there was one buyer that bought a particular segment of the platform business and left a few other ones out. And one of the ones that was left out was LK. And so when they had like a smaller set of them left, it was right for me to be able to buy back. And what I think was really unique, Will, is with really no exception, everyone who was at the business when I bought it were people that I had worked with before. And so these were, familiar faces. A lot of them I had hired before. And so it was really neat to be able to come back. LK is in Houston, which is where, I live still. And so this is a business very close to home in a very literal way. And it's been really neat to have such an understanding of a business that I can really understand what it takes to run it well without having to be there all the time. And so I've got some really good managers in that company. We have a really good long-term working relationship, and the business is doing really well and continues to, operate both the Miller & Weber and the LK product lines going forward. And that's just been a lot of fun to come full circle on that.
Yeah, absolutely. That's great, Eric. And tell us what the overall revenue of TXE is today. I meant to ask that earlier.
It's about $25 million.
Well, Eric, I have to say, despite the fact that you have this long-term horizon, which, as I said, I love, I always love that just kind of personally. If you are really have built a $25 million and that number grows of tick businesses that are adjacent to one another, and that there's a certain logic to them, and they kind of operate as a package offering, I imagine you're going to be able to command a premium for the entire thing if you want it. I mean, you are, as we've now touched on a number of times, in a very hot space, and you have generated, you built a $25 million business in this very hot space. So you're probably already getting a lot of inbound.
It's interesting. It does happen. So far, we've gotten a lot of inbound for the individual companies because we really run those, try to run those individually. And so we've gotten inbound on the individual businesses, but it's definitely, we like when those, makes you feel good when that sort of thing happens.
Sure.
But I think, we built a niche around being able to get these really small businesses, and we've got a lot more, left to do before I think we're ready to have any sort of conversation like that.
Great. Well, Eric, we were introduced, let me say, by Reed Pennebaker. And Reed, of course, runs ETA Circle, the ETA meetup in the Houston area in Houston. You guys know each other. He thought you'd be a great guest. He was not wrong. And you will also then be on stage at ETA Circle sometime. I don't know yet when, but audience,
in the fall. Yeah, maybe September or October, in that time frame. It's really great. Yeah, Reed's done a lot of really good things with that group, and I appreciate the introduction. It's been fun to watch his story unfold, and at bits, different moments in time offer at least some of my experience on what's worked and not worked. It's been fun to be able to have that network, and I generalize that to, I think, the search community as a whole is really one that's receptive to that. People being able to offer their insights and perspectives and kind of feedback to folks, and I've really valued that, and kind of getting back into it with this conversation and with ETA Circle has allowed me to realize, there are some real things that we've learned. And if we can share that with folks getting started, that's always a good thing. Yeah,
absolutely. Well, listener, the date hasn't been locked down, but it is going to be sometime in the next couple of months. Check out etacircle.com just keep your eye on that. I don't think there's a listing for the event yet because it hasn't been locked down, but that's where you'll find information on how to go see Mr. Eric Calderon here on stage in Houston, if you like. Eric, thank you very much for coming on, for being so transparent and sharing this 13-year journey into buying businesses that's been really successful for you. So we really appreciate your time.
Yeah, absolutely. I've enjoyed it. And thanks, Will, for all you're doing to unite this community.
Hope you enjoyed that interview. Don't forget to subscribe to the Acquiring Minds newsletter. We send an email for every episode, with an introduction to the interview, a link to the video version on YouTube, and soon, key takeaways, numbers, and more essentials from the interview for those of you who don't have time to listen or watch it. Subscribe at acquiringminds.co. You'll also find all our webinars there on the website, both those we have coming up and recordings of past webinars. At this point, there are over 30 webinar recordings, a wealth of information on all the technical nitty-gritty of buying a business. acquiringminds.co.